and welcome to IndiNations, 7 Generations Investing. I'm Jeremy Bryan, and this is powered by Indy Wealth. Today, we're going to talk about an interesting subject because in tribal finance and native governments, there is a lot of need for financing and just capital access in general. And traditional bank financing, obviously, probably the predominant use of financing. But one of the things I wanted to talk about today is something that may not be as communicated, but there may be some opportunities and maybe some levers for tribal nations and tribal foundations to pull with regard to securities-based financing. And so really, I titled it Accessing Capital Outside of Traditional Banking. And so that's what we're going to talk about today. So let's get right into it. So let's talk about the challenge or the problem here. First is that tribal organizations need access to capital. There is no question about it. To build and thrive and to advance your communities, a lot of the things that you're going to want to do are going to require financing to get it done. There's no question about it. But there are some barriers that are somewhat unique to tribal organizations, somewhat universal, but starting with collateral. Is, traditional bank financing obviously usually uses collateral to give loans based upon the value of that collateral. And a lot of times the land held in trust or the things that tribal governments and tribal organizations have at their access point can't be used for traditional bank financing collateral. It does happen. So in instances where that's the case, the collateral is the issue, is that there isn't enough collateral to doing that. And to be completely honest, securities-based financing does not solve that problem, but it is a barrier to access overall. I think a unique aspect to the barriers is the sovereignty, immunity, and the things that come with being a tribal organization that is a sovereign nation. Is that banks, especially banks who have not had a long legacy and history with Indian country, tend to equate that with higher risk. So there's either the component of restriction and saying, well, we can't have, we need a waiver of your sovereign immunity. We can't govern under those laws. Here's what we can do, or we're just going to ignore it completely. I've heard that actually from banking colleagues that I know that say, we'd love to be able to access more in Indian country, but the sovereign component is just our risk managers won't do it. Others have had more success doing it and really kind of cultivating their loan agreements and things like that to be accessible to sovereign communities like tribal organizations. But sometimes that comes with a higher risk perception. And despite that, it's not really necessarily a higher risk, but to the banks that perceive it, it is. And so sovereignty can be a barrier to capital access as well. And I think number 3, especially for rural tribal organizations where, it's a bit separate, is that honestly just a lack of available options. I know the internet has changed that to a certain extent, but still there's just less banking in those areas and less people concentrating on those areas as a source of banking. And so when you have lack of available options, oftentimes you have lack of competition. And so it's the 1 or 2 people that you can work with and you take whatever you can get, rather than being able to source from multiple avenues and really having them compete against each other. That's the more, predominant way. And that's obviously the better way to get better rates, better financing terms. But lower lending presence does create that barrier as well. So I want to talk about traditional debt financing, going to a bank, basically. So loans are secured by revenue streams or non-trust assets, whatever it is that secures the loan for that collateral. And so the collateral can be something, tangible assets, equipment, buildings, these kinds of things. It can also be revenue streams from gaming or from infrastructure type of stuff that's creating a recurring revenue stream that a lender can use to saying, okay, I see this is coming in to satisfy the debt of the loan. Here's what we'll give you as a result of these future streams of revenue that we see coming in. And they'll take a little bit of risk on that provided, but they're going to give themselves enough buffer of protection to hopefully, never need to call or do anything aggressive on that collateral. Others, intangible assets, accounts receivable, inventory, these kinds of things. Inventory is a little bit more tangible than that, but less equipment and buildings, if you will, as there are other avenues of collateral you can use to provide the basis for a loan from a traditional bank. The pros of traditional bank financing, obviously high principal amounts. If you have the proper collateral and you have the proper structure and you have the proper lender that you can work with and all your paperwork is put into place, you can get a loan for a significant amount for a health facility, to do the things you want to do to grow and prosper over a longer period of time. So traditional bank financing absolutely has a place, and especially for higher priced goods and services and things you want to provide over longer periods of time, traditional bank financing will be an absolutely essential source for you over a longer period. You'll have the loan repayment terms. You'll have kind of that contract in place. You'll know what the terms are up front. The cons of traditional bank financing, again, goes back to the barriers of access. Is sometimes they tend to be risk averse, especially for things in organizations they don't know very well. But also just the general process can be very lengthy, right? And there can be a highly rigid component of getting the things that they need to get this loan across. And so the process can be very long, from determination of the funding needed to actual funding received, can be very long and very stressful and very arduous and very paperwork oriented to get it across the landscape. Now, again, everybody's trying to cover their avenues. Everybody's trying to make sure they're doing what they're needing to do. So there is a reason for that, but it is a con in that it will take some time to get this across, especially the more sophisticated requirements as needed. So in my opinion, bank financing absolutely has a place. There's no question about it, but it isn't the only option for tribal organizations to use. And I really think, especially as we go forward, there are some other financing mechanisms that in certain regards just make more sense than using traditional bank financing for everything you want to do. So let's talk about what may be a potential untapped resource for financing. And I believe that's, non-trust capital. We can unlock some liquidity in here for investment purposes or for financing what we need going forward. And so those sources are a little different. So settlement funds, non-federal trust assets held in private accounts. So you own the assets, you can invest as you see fit. You have control and access over these funds. Unrestricted revenue, again, coming from gaming, coming from infrastructure, the revenue that comes in that's not going out, that's being used, whether you're housing it for a rainy day, contingency planning, whether you're using financing, you can invest those resources to hopefully grow over an extended period of time. But you can also utilize, once you have a stabilized source, you can use that revenue for further financing down the road without having to sell those assets. And I'll get into that in a minute. And again, more permanent funds such as endowments or perpetual tribal funds, if they are sitting there and they are invested and it's part of the investment policy statement that you could utilize these for financing purposes, there is absolutely an avenue to take advantage of. All these may be a source of capital that can be accessed for financing solutions, and I'll get into the mechanisms as to why. So what we call that is securities-based financing. And so it's a pool of assets that you use to finance. And so whether you get a loan or whether you talk about one of the other things I'll talk about here in a second is an options contract, you can use that to get cash up front to then have a repayment term just like you would a traditional loan. So we use the asset base to secure the financing for other projects. So let's talk about the first one on the left, which is a securities-based line of credit. Now, for those of you who own homes, you may know a home equity line of credit operates very similarly. And so most custodians and most institutions where you house the assets will allow you to borrow based upon the assets that you have within there. So it'll allow you for a flexible line of credit, and it's secured by your investment portfolio. And so if you have an investment portfolio or you've developed, a couple of million or whatever it may be from a financing perspective. Now, again, there's asset thresholds here, right? You can't do this with $20,000. It's really not going to be feasible. But for a larger asset base and amount, you can basically get a credit secured on that investment portfolio and have a line of credit to borrow what you need and when you need it. I'll get into some of the attributes here in a bit, but it's really kind of that line of credit, just as you're thinking about if it's a home equity line of credit and those kinds of things. This is a securities-based line of credit. One that may be not as familiar to you all, but has been around and institutions have been using them. And we're starting to see wealth managers use these a little bit more frequently for their high net worth and ultra high net worth clientele, is what's called a short box spread. And I'm really not going to get into the weeds of the construction of a short box spread. That's a much more entailed conversation. But I really want to kind of discuss what it's meant to do. And it's really a 4-part options trade. So there's an options trade that you put together that ends up functioning very similarly to a fixed rate loan, in the effect of you put the option structure together, you get cash up front, utilizing, again, the assets that you have as part of the collateral for this. And then you get the cash up front, and then you have a payment date at expiration. So you can set those terms ahead of time about whether it's 6 months, a year, 2 years, whatever that may be. And you will know the terms and you will know the payment date that you need to make that. It's usually a balloon payment at the end. It's usually an ending payment. But the nice part about it is, again, both of these instances, you can access cash and financing without selling your assets. And so, as most of you know who have assets that are invested over longer periods of time, these are going to grow for you, right? And you want to not disturb that compounding, right? You want this to grow and grow and grow over a longer period of time. It's how you can survive and thrive over an extended period, by using these assets to grow over an extended period. This allows you to access cash and access financing tools without having to sell assets. So you continue to compound that growth over a longer period of time while accessing financing for things you may need outside of just these traditional investments. That's where this comes into play as a good opportunity for tribal organizations that have these types of assets to access financing that is outside of traditional banking. So what are some of the attributes here of securities-based line of credit and a box spread? First and foremost, no question, it requires a substantial asset base. Both of them are basically marginable, if you will. And so, if you want to do $1 million worth of financing, chances are for these investment pools, you would need at least 2 million. And our recommendation would be more than that, to accessing that level of financing based upon either a securities-based line of credit or a short box spread. Either way, you're going to need a substantial asset base. So this isn't, I have a building that I can do that. That's traditional bank financing. This needs to be an investable asset pool that you have at your utilization, that you have control over, that you can then lend off of and use financing tools for. Access cash without selling assets. I think this is one of the best positive attributes of these is, again, if you have access to these assets and you have these assets and you're saying, well, I have a financing need in the next 6 months, 12 months, 2 years, 3 years, but I really don't want to sell these things because I want them to continue to grow. This is how you could do that, is you can access financing utilizing these assets as your collateral, and also allow them to grow over an extended period of time so that you're not disrupting that growth and you're not selling down the assets, which lowers your growth profile over a longer period of time. So it can allow the financing, especially if you know that, hey, we are expecting revenue to come into this thing in month 18 to pay off what we're, let's say we do a 2-year financing. Well, we're going to have the money in 18 months. This is an excellent way to develop that financing without having to sell assets in order to do it. Can be accessed relatively quickly. I'm saying this in terms of compared to bank financing, which we talked about as the cons, and saying the rigidity and the time frame it takes to go from start to finish can be very long. Here, this can be relatively quick. It's certainly faster than traditional bank financing. I would say your fastest method is your securities-based line of credit. That can be established relatively quickly. A little bit longer because you have to develop the infrastructure and you have to do the options contracts. You have to trade them a little bit. It's a little slower for the box spread, but it's not immensely slower. So this is a little bit slower, but the securities-based line of credit, it can be accessed quite quickly as long as the infrastructure is in place and allowable to do so. The big one here I underlined is market volatility and margin risk. Both of them have these. And again, this is why I often say you want to have more. They traditionally only allow you about 50% of your asset base. So if you have $2 million, you can access $1 million of financing. I suggest even being more conservative than that because you are going to have to fund things if the market has difficulties. So under that scenario, I would recommend a more conservative option to avoid that capability of having to incorporate cash from other resources in order to make the margin component of this financing. Can be used for a wide variety of purposes. Now, it's not everything. Typically, what you can't use these for is to leverage up more investments, right? If you're saying, well, I really love Apple, so I'm going to take a securities-based line of credit and then buy Apple. You're going to probably do that on a margin account, which is different than both of these. This isn't what these are designed for. These are designed for, I have outside expenses that I want to handle and take care of and use financing for, and I want to use my investment pool to do that. That's what these are designed for, not to lever up the investments in the portfolio to try to enhance your level of return within that portfolio. Not designed for that. So let's talk about some of the pros and cons of both the line of credit and the box spreads. I'll start on the line of credit side. Is that pros, again, relatively fast funding, assets are allowed to grow. I still think that that's probably the best use case here, is that you're not utilizing these assets and selling them down. You can continue to have them grow, and hopefully those will grow to an area where maybe you can even satisfy the loan through the proceeds of growth that you've had. So those are, possible avenues, but I mean, just allowing, not disrupting that long-term compounding that we've talked about before, I think is really, really powerful. Flexibility of use. And I know both of these have potential tax efficiency. I'm not going to talk about that a whole heck of a lot here because most tribal organizations are already exempt in certain regards. But if you have certain components that are taxable, there is some tax efficiency in both of these, and we could absolutely have that conversation. The cons on the securities-based line of credit, again, large portfolio, limited loan to value. So you're not going to be able to access 100% of this. I wouldn't even say 50% of it would not be recommended on my side. It would be less than that. But how much risk are you comfortable with? Again, it's a risk trade-off argument about how much financing can you do on this asset base and still be comfortable that you can meet the margin requirements if the market were to have a downturn. On the securities-based line of credit, this is important, is that it does have a variable interest rate and it's dependent on the lender and the structure. So their variability here, I would call this is probably assume it will be higher than traditional bank financing. So in a securities-based line of credit, this is accessed quickly and you can get to work and you can get the financing out. You don't have the rigidity of the bank loan component of it. So the speed is probably the better attribute here, but you'll probably pay a little bit more here than you would in a traditional bank loan. Not always. Sometimes you'll get more favorable terms based upon just kind of, again, if there's limited amount of lenders and they're not real willing to lend to you, you may get better terms because you have an asset pool that you can lend off of. So you have to kind of pay attention to the variability and see where the structure matches up. But I would call the speed of access the better attribute than the cheaper access. Again, you have margin call risk, and not all your assets can be utilized. And again, as I said before, this isn't like a building loan. This is much more, I have a pool of assets, whether it's in stocks and bonds, that I can use as collateral for a securities-based line of credit. On the box spread side, there's some very high similarities in the effect of it's relatively fast. It's slower than the securities-based line of credit, but it's still faster than traditional bank financing. Again, assets are allowed to grow and you have flexibility of use. You do have some potential tax efficiency in these as well. Again, that's if applicable, and so I'm not going to spend a ton of time here. This is probably one of the different attributes from the securities-based line of credit that's important, is that you have a fixed interest rate here, and they can often be at pretty favorable levels, sometimes just slightly over treasury rates. And so you really have, again, it's based upon the structure, the length, the amount of assets that you're investing and borrowing against. So it does have a variable structure at the outset in the effect of you don't know immediately what it will be, but it is a fixed rate loan going forward in the effect of you get the cash up front and you know how much cash you have to pay at the end based upon the quote unquote interest. It's not really interest that you're paying, but it is the differential, which kind of equates to the same thing. On the con side of a short box spread, again, large portfolio advances, limited LT loan to value on this. But again, similar to the securities-based line of credit, it's there if you need it, and it's an accessible form of financing that's different from the bank. Here's the biggest con, in my opinion, is there is a high degree of complexity in this. This is not something we would recommend that you all do yourselves. This requires professional guidance and professional support to understand what it's setting up, to understand the terms, and also to execute and implement on the strategy. I really recommend professional advice for this if you want to take advantage of a short box spread to do some financing down the road. Similar to the securities base, there is some margin risk and there is some, not all assets can be utilized here. But again, our recommendation, I think both of these are avenues to at least take a look at and saying, do we need financing a little faster? Do we need a short-term bridge for something here? That's where these probably fit a little bit better because you can access them very quickly and you can get them to work much quicker than traditional bank financing. So I think those avenues work a little bit better. But again, I would have professional guidance for which to use and how to execute and implement under the best strategy for what you need for those asset financings. In closing, it's really just use all the tools at your disposal. I think that that's the best approach you can take, is choose the right tool for the job. Whether that's bank financing. Again, I am an advocate of bank financing. I think it's absolutely essential, especially your larger scale projects. Bank financing is always going to be a part of that. And there are some excellent Indian country bankers out there, commercial bankers that can really help you and assist with what you need done. So this is not an attack on them at all. This is just a different tool that you can use for some other resources when that's not the optimal path to take. Government programs are still going to be there. There's funding mechanisms, there's grant mechanisms from the government that you should absolutely look at for the financing you need for whatever may be that you're building, because sometimes there's advantageous things and you want to take advantage of those as much as possible. In the same way, grant funding and external resources, not just the government, but outside foundations are doing things all the time to really try to help Indian country and tribal organizations build the things they need to build to make their people better over a longer period of time. So take advantage of those when you can, find them, do the research to try to find access to these things. And I really advocate for those because especially the government programs and the grant funding, oftentimes those can be highly advantageous and maybe even grant based and not financing based, to where a portion of the capital is actually they're funding some of your project for you. That's great capital if you can have it, as long as the strings attached aren't too aggressive for you. I think that those are avenues you should absolutely take. And again, lastly, here is the securities-based financing. I think within Indian country, for those that have asset pools that are sitting there, I think this is an opportunity that maybe isn't utilized as much as it could be. And especially those short box spreads, which maybe, people just get kind of confused on the options and they're like, well, I don't know what I'm doing. A professional such as IndiWealth or anybody that you're using that knows these things can really walk you through the assumptions and the risks and the trade-offs to help you understand how that financing could potentially be advantageous for you as part of your overall solution. So again, it doesn't solve all the problems, but it can be a part of the tool base that you use to get the job done. So if you want more information on this, I'm going to have in the link below, I'll have access to our resources page, which has our tribal finance capital access. The slide deck is fairly similar to this. It has a little bit more information, but hopefully just kind of helps you provide what you need. But also, if you have questions or have thoughts on what you're doing here and how you could implement this, and does my policy statement allow me to do this, please give us a call and we'll have a review with you to try to determine what's the best path for you to use securities-based financing. Well, that's all for us this week. Tune in next week. We'll have our next Indian country topic. But until then, thank you very much. Take care of yourselves.